Hey everyone, welcome back to Corporate Decoder, the place where we try to find out if companies are secretly running a shell game with their numbers or if they're actually building something solid. In this video, we're diving deep into the very first report from the Franklin BSP Lending Fund. Now, this isn't a typical company report, it is more like the rulebook for a new fund, laying out all the costs, risks, and how it plans to make money. Think of it as the blueprint for potential investors, complete with a clear warning. This could be risky stuff. So what is the big picture here? This fund, Franklin BSP Lending Fund, is essentially a way to invest in private debt. That means loans to companies that aren't publicly traded on the stock market. The goal is to make good returns while also providing some income. It is set up as an interval fund, which is a bit fancy, but it basically means there are limits on when you can get your money out, even though they try to offer regular opportunities to do so. They're focusing on middle market companies in the US, those that need a substantial amount of capital between $25 million and $100 million. Now, before we get into the nitty gritty, it is important to understand this filing comes with a truckload of warnings about the risks involved. They're really trying to make sure you know this isn't a sure thing. They talk about economic uncertainties, global events, market disruptions, and even political instability, saying these things could negatively impact their business and the value of your investment. Basically, they're covering their bases by saying, hey, the world is crazy and that could affect this fund. Let's talk about the money because that is usually the most interesting part. The fund hires a manager, Franklin Templeton Fund Advisor, LLC, and a sub-advisor. Benefit Street Partners, LLC, the manager gets paid a fee. Right now, it is set at 0.75% of the fund's net assets each year. But, and this is a big but, the manager has agreed to voluntarily waive this fee until the 8th of October 2026. This is a common move to make a new fund more attractive, essentially saying, we'll take less money for now to get you in the door. But after that date, the fee goes back to 0.75% unless they extend the waiver. Then there are other fees. Different classes of shares have different fee structures. For example, Class S shares have a 0.85% distribution and servicing fee. Class D has 0.25% and Class M has 0.50%. Class I and Class R6 shares don't have these fees. This means the fees you pay can really depend on which type of share you buy. They also mention that financial intermediaries like your broker might charge you extra fees on top of everything else, up to a 3% cap for certain share classes, but not for Class I or Class R6. Here is another significant cost to watch out for, an early repurchase fee. If you decide to sell your shares back to the fund before you've owned them for a full year, they'll hit you with a 2.00% fee. This is meant to discourage short-term trading and encourage long-term investment, which makes sense for a fund focused on private debt. They're trying to build a stable portfolio, not a trading desk. Now, let's look at the big picture risks they're highlighting. This is a non-diversified, closed-end management investment company. Non-diversified means they can put a lot of their money into just a few investments, which is riskier than spreading it around. Closed-end means they have a fixed number of shares. Unlike regular mutual funds that can create or redeem shares daily, and limited operating history means they are pretty new. They're trying to generate returns by investing in private debt, which can be pretty complex and illiquid. This means it might be hard to sell your investment quickly if you need the money. They do offer quarterly repurchase offers, but they might not be able to buy back all the shares you want to sell. And there is that early repurchase fee if you sell within a year. Their main goal is to get you returns that are fair for the risk you are taking, and also provide steady income. They aim to do this by investing in private debt of middle market companies. They're not just investing blindly though. They emphasize sourcing deals through Benefit Street Partners' extensive networks, prioritizing opportunities where they can be a key capital provider, using a flexible and creative approach to financing, and optimizing the risk-reward balance for each investment. They also highlight their focus on fund-level risk management and diversification, even though they are a non-diversified fund. They might also use leverage, which means borrowing money to invest more. This can boost returns, but it also amplifies risks. They can borrow up to about a third of their assets, or even half if they issue preferred shares, though they don't plan on issuing preferred shares. This leverage doubles down on both potential gains and potential losses. Looking specifically at the financial statements, which are still very early stage, the fund reported $100,000 in net assets as of the 9th of July 2025. This is just seed money, mostly from Franklin Resources, Inc., which initially owned 100% of the shares. The expenses at this early stage, like organizational costs, were covered by the manager and will be reimbursed later, but with some limitations, they're also deferring most of their offering costs over a year after operations begin. Scroll total assets, $714,784 total liabilities, $614,784 total net assets. $100,000 swung to scroll the financial statements as of the 9th of July 2025 show a very basic picture. Total assets were $714,784, with liabilities of $614,784, leaving net assets of $100,000. This $100,000 is essentially the initial capital. The expenses for organization and deferred offering costs are significant at this stage and are being managed through fee waivers and reimbursements. Now for the actual investments they've started making, as of the 31st of August 2025, the portfolio is heavily concentrated in senior secured first lien debt, making up 87.7% of the fund. Most of this, 76.7% of the total fund, is in bank loans, spread across industries like business services, consumer, financials, healthcare, and industrials. They've got big stakes like CPI Holdco B LLC with a face amount of $1.5 million and Modern Wealth Management with several loans totaling over $4.4 million. They also hold corporate bonds and notes, which make up 11% of the portfolio across sectors like cable, financials, healthcare, and utilities. They also have some subordinated debt at 7.5%, all in corporate bonds and notes within energy, industrials, and technology sectors. These are riskier because they get paid after senior debt holders. For example, they hold Devon Energy Corp senior notes and Boeing Company senior notes. The total cost for these investments is a significant chunk of money. To balance this out and provide some liquidity, a significant 26.5% of the fund is in short-term investments, specifically in Western Asset Premier Institutional Government Reserves. This is likely a money market fund or similar vehicle, providing a safer place for some of the capital. So what is my take on this? This fund is aiming for higher returns by investing in private debt, which is inherently more complex and less liquid than public markets. The fee structure is important to watch, especially after the fee waiver ends. The early repurchase fee is a significant deterrent for quick exits. The concentration in senior secured debt is their primary strategy, but diversification is limited, meaning the health of a few key investments could really impact the fund. They're clearly trying to manage risk through careful sourcing and due diligence, as detailed in their investment process, including the use of an independent board and committees to oversee management. Looking at the liabilities and early expenses, it is clear this is a fund in its infancy. The initial capital is small, and a good portion is in short-term investments to manage liquidity. The real test will come as they deploy more capital into these private debt instruments and navigate the associated risks, like interest rate changes, borrower defaults, and the general economic landscape. Remember, private debt is not for the faint of heart and requires a long-term commitment. Ultimately, the success of this fund will heavily rely on the expertise of Benefit Street partners in finding and managing these private debt deals. Their ability to navigate defaults, market downturns, and regulatory changes will be crucial. For investors, it is a bet on their capability to manage risk effectively in a less transparent market. Alright, that is our initial decoding of the Franklin BSP lending fund setup. What do you think about this strategy and the risks involved? Are you excited about private debt, or does it sound too complicated? Let me know in the comments if you like this deep dive. Give us a thumbs up and don't forget to subscribe for more corporate breaking downs. And hey, if you want to dive deeper into these discussions, join our Discord community. Link in the description below. Thanks for watching, and we'll see you next time on Corporate Decoder.